Good morning. Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I'm Rose Marcello. I'm client portfolio manager at IGAM, and with me today is David McCulla, portfolio manager, fixed income. Alongside Alexandre Morin, David manages about 20 mandates within fixed income, among which IA's flagship core Canadian fixed income. Good morning, David.
Morning, Rose.
Well, thank you for being here.
Thanks for having me.
Today, what we're discussing, so there's been a move higher in rates in Q1 2024 because expectations of central bank rates cuts were adjusted. And I'd just like to discuss how you and the rest of the fixed income team reacted to this turn of event. And going back specifically to bond rates, so there was a material bond rally in the last quarter of 2023, then bond rates surprisingly moved higher in the first quarter of the year, driving bond prices lower. What caused this market movement?
Yeah, it's a great question. And I think in answering the question, let's first look back at the factors that caused bonds to rally so strongly in Q4. And really, it was three factors that explain the majority of the Q4 rally: economic data, monetary policy, and bond supply. And looking at them quickly in turn, on the economic data front, we had growth in inflation. And in the latter part of 2023, we saw weaker economic data growth, pointing to slower growth, really a softening the labor market, and a decline in the level of inflation. From a monetary policy perspective, we saw a change in tone from both the Bank of Canada and the U.S. Federal Reserve, suggesting that their hiking cycle is over and that they're going to start cutting rates in 2024. And if you look globally, many global central banks also shifted their tone of their language. And then finally, looking at bond supply, and we had the fall funding update from the U.S. Treasury. It showed lower than expected increases in the borrowing requirements from the U.S. Treasury. So I think that the combination of weaker growth, shift in tone from central banks, caused markets participants to really aggressively price in rate cuts from both the Bank of Canada and the U.S. Federal Reserve. And if we look back at the end of last year, the market was pricing in over 5 cuts from the Bank of Canada and then over 7 cuts from the U.S. Federal Reserve. So turning now to your question, what caused rates to move higher in Q1? I would say two main drivers that are connected. Turning back to economic data and looking again at growth in inflation. And more so in the U.S., but also in Canada, we've seen economic data come in stronger than expected. And that's led most to believe that we may see a soft landing or perhaps even no landing as compared to a hard landing economic recession. And then connected to that, monetary policy, we have seen consistent messaging from both the Bank of Canada and the U.S. Federal Reserve that they really want to be patient and have more confidence that inflation is sustainably returning to their 2% target. So this messaging, it's also pushed back on what the market had priced in. So I would say these two factors explain the bulk of the move higher in yields that we've seen in this quarter.
Interesting. So, but were you and your team surprised by that market adjustment in expectations for bond yields?
No, and if you recall what we were saying at the time, we thought the market was being far too aggressive in both the timing and the magnitude of expected rate cuts. So, as I mentioned, the market was pricing in over 7 cuts for the U.S. Federal Reserve for 2024, with the first cut fully being priced in for March. So clearly we haven't seen that, and the market's more in line with what the Fed was saying all along, that we should see 3 cuts in 2024. So this backup in yields as a result of the repricing really didn't surprise us at all.
So maybe my next question will be, if we reflect back on how your portfolios were positioned going to 2024, did anything change during the last quarter due to that move?
Yeah, we certainly made some changes during the quarter, and maybe look at a couple aspects of the portfolio. So looking first, our provincial exposure, we maintain a relatively neutral position throughout the quarter. We had seen some widening in provincial spread products from the recent tights, and we expect the spreads to widen a bit more as provincial budgets are released. So we'd use further spread widening really as a buying opportunity within our provincial exposure. We were active in our corporate bond exposure. We continue to add some shorter dated bonds in the portfolio while reducing exposure to longer dated corporate bonds. We're still overweight corporate bonds, but we believe that shorter dated corporate bonds offer a far more attractive risk profile than their longer dated counterparts. And then finally on duration, we were overweight. We brought that to a more neutral position going into the quarter and maintained basically a neutral duration throughout the quarter. And then as bond yields moved higher, we bought some duration to bring it overweight and then reduce that exposure as bonds rallied, taking a bit of profit there.
Good. And any changes into your outlook? What's your take for the next few quarters?
Yeah, we still have a positive outlook on rates. Bond yields still at multi-year highs, so we continue to believe that bonds offer a very attractive risk-reward profile. What's supporting this view is that we do expect growth in Canada to continue to slow in 2024, and that inflation should also continue to move lower, causing the Bank of Canada to lower its overnight rate. I say one of the risks to our outlook is that inflation remains stubborn, or growth comes in better than expected, and or governments continue to have to issue more bonds than is currently expected. One thing I'd point out, and we pointed this out last quarter, while we do have a positive outlook for bonds, we do expect to continue to see some volatility in the bond market. And the primary driver of that is going to be what the markets are pricing in as far as central bank cuts for this year. I would say on a positive note, when it comes to volatility, it does afford us the opportunity to be active and tactical in our portfolio positioning, as was the case last year. And then looking at the yield curve, we believe the current inverted yield curve is going to begin to steepen materially once central banks begin cutting policy rates, and that's going to create even more tactical portfolio position opportunities. And then just finishing on credit, as I said earlier, we still have a positive outlook on credit product in the near term. However, its risk reward is less compelling today than a few months ago, given current valuations.
Oh, well then. So I'd say your thesis, your investment thesis of the past few months on the opportunity in fixed income is still alive. Any final thoughts that you'd like to leave us with?
Two final thoughts. First, we'd like to thank all our advisors and their clients who put their trust in us and invested in any of our bond funds that we manage. And secondly, the final thought I would leave is based on our outlook. We do believe bonds should perform well this year. And if any of our partners in sales would like to hear more about our views and outlook, I would invite them to reach out through yourself. Our team would certainly be happy to share our thoughts with them and their clients.
Great. Thank you so much, David, for being here today.
My pleasure, Rose.
Have a great day.